This chapter deals with the investment decision and drawing up of cash flow tables. So just as an introduction, this is mainly a number crunch type of chapter, and you're going to be doing things and then we're going to be marking them. So it's something that is very, very interactive and should be done with the video. You should not try to do the example by yourself without looking at the video itself. There's an introduction in here. These are the types of questions you could get asked on NPVs. I'm not going to go through the list. You can read through it yourselves. And how should you structure a capital investment appraisal question? I'm going to come back to this at the end and just discuss it with you after we've done the example, because you'll understand why I want you to structure the stuff in the structure that you do it in once I've done an example with you. But basically what you should know for now is the following. If you're writing an online paper, there's no reason why you shouldn't actually do an NPV question on an Excel spreadsheet or on a Google Sheet. What I would like you to do generally within an NPV calc is have something that's a heading that says included in the tax calc, have another heading that says not included in the tax calc, and another heading that says tax calc. And I'll show you why we've got those three sections when we start going through a question. Okay, now, as far as this question is concerned, the question can be found on page 3. What I'd like you guys to do now is to read the whole question itself, and I'd like you to pause the video at this point in time until you've read the whole question. Okay. At this point, I'm going to assume that you've read the question itself. It basically asks us what option to actually choose within a question itself. We've got two options. We can either, by reading the question, you can see we can either sell our research or we can keep our research and develop our own product and try and make money from our own product itself. So I'm going to actually just go through this with you. So it says Beta Inverter was set up 2 years ago to exploit Eskom's load shedding problem, selling inverters into households. It says 1 million. Now, when you were reading through the question, I'd be very, very interested to think about what you were doing. If you're doing an NPV question, everything that is a cash flow is something that you should be marking off while you're reading through the question. So that's a potential cash flow, the million. So $1 million was spent on developing inverter technology that could be used within households. Assume that a tax deduction was claimed in full for an expense in the prior tax year. So that was fully tax deductible. The company undertook a research project and believed that there will be markets in Durban, Cape Town, and Joburg. It was decided to open up one shop in each of these 3 locations. So if they give you sales per shop, remember we need to multiply it by 3. It says market research that cost 70,000 to perform, believed that there was a viable investment opportunity. Again, that might be a cash flow. Okay. It says Arrival also believed that the product was viable and made an offering to buy the technology. The company would receive 1.3 million for the technology itself. So it would receive 1.3 million for the technology. Should the company decide to produce inverters, the following is relevant. So we've got 2 options here. Now, essentially, when you read the question, it said that you would have 4 years use out of each of the machines. Where did you see that? In the question. Sorry. It says 4 years stores were set up and 3 stores were leased for 4 years set up with operating lease assets. So inside my cash flow, how many years do I need to put in here? I'm going to be able to work with time period 0, T0, just put caps in. And if you're using Excel, it's nice and easy to just take stuff across. So you just need to clip on that side of it and you can actually take out time period 1 through to 5 with it. So with Excel, if you just want to drag, you can just get that little block across there and it'll take it all the way up to T4 and it'll create absolutely everything there for you. Going back to the question itself. Okay, let's start putting cash flows in. So what I'd like you to do at this point in time for the research, we've identified the 1 million, the 70,000, and 1.3 million. You have two options that you can do. So on my Excel spreadsheet, this will be for option 1. And I'm going to actually just copy the spreadsheet. And what I'm going to do is, for option 2, I'm going to just paste it in as well. On an Excel spreadsheet, you can make things big or small at the bottom. And I'd like you to do what you need to do for each of the two options itself. Option 1 being selling this, or option 2 being developing it for ourselves. Please push pause now. When you have finished with this, deciding where it goes onto your tax flow calc, press unpause the calculation and I will go through this with you. I'm assuming you've done this, so let's start off with the research project. If we decide to carry on with this project itself, what's going to happen with the research project? It's already incurred. It's what we call a sunk cost. Okay, so what are we going to do with this? We are going to do the following. Now, inside the notes, what I've done is I've got considerations with doing NPV questions. I want to just discuss the concept of a sunk cost with you first. So it says, if research and development is being done prior to the investment project commencing, usually this is a sunk cost. It says the sunk cost usually cannot be recovered, so it should be placed into a cash flow at a zero value. If the research can be sold, the relevant cost is the amount that it can be sold for, taking tax effects into account as well. In cases like this, though, there are two options: sell research and invest in a research project. Alternatively, one NPV calc could be done, and the amount that you could sell the research for after tax is a relevant cost in one calc. But normally, we need to do two options, so let's actually do this and take this into account. Let's go back to the question. Let's make sure we understand. So $1 million was spent already. So as far as option 1 is concerned, that relevant cost is lost. Okay? And we've got things that will be included in a tax calc and not included in a tax calc. So what's going to happen here is there's a research cost last year. And what's going to happen, I just want to actually just lock and freeze panes here. So view, freeze panes. I'm going to freeze panes in this question so I can still see what's on the top of the question itself. And what's going to happen here in time period 0, the research cost, the relevant cost for last year is 0. But we need to actually provide some sort of reason for it. So I'm going to just put a reason down. That's because it's a sunk cost. Okay. So research cost last year, it was a sunk cost. We're going to put a 0 in over here. This is also going to be true of option 2. So this is option 2. It's not included in the tax calculation. I'm just going to copy it across. Okay. So here it is. Sorry. Research cost here. Copy. Sheet 2. I'm just going to copy it across here. It's exactly the same reason. Research cost is a sunk cost. We're not going to include it in either of the options itself. And we've got option 1 and option 2 here. Okay, so option 1 is we're going to sell it. Let's carry on. Guys, let's carry on reading the question itself. It says, another cash flow, 70,000 market research to perform believed there was a viable investment opportunity. Again, this has been spent. No matter what we do, we are not going to be able to recover that 70,000 Rand back. So what are we going to do as part of the solution itself? It's a sunk cost. We're going to say, listen, market research. It's a sunk cost. And again, I'm going to put a 0 into this because it is not going to relate to our investment calculation at all. I'm just going to copy this and I'm going to put it down into option 2 as well. the market research. Ooh, I've spelled research wrong there. Let me just go check. Let me just go fix it. Research cost is 0 there as well. Okay, let's carry on with the question. Okay. It says, we've highlighted this one, there are 3 cash flows, so for each cash flow itself, we need to work on it. It says we could receive 1.3 million rand for the technology itself. So we could receive 1.3 million rand for the technology, okay? Would that be subject to tax? Of course, the moment you sell something like this, it would be subject to tax. So what's option 1? Option 1 is the sale of this. So included in the tax calc over here, it's sale of market research. What's going to happen as far as sale of market research is concerned? We are going to sell it in time period 0 for 1.3 million rand. And we're going to put that into our cash flow, 1.3 million rand. Now, let's just do a tax calc at the same time. So normally when we've got a transaction, it's always better to actually just go and do the tax calc with it immediately. So what happens is, as per the question, we have got a cost of 1 million. Okay, it was claimed in full for the expense for the prior tax year. So what should you do here? I've sold something that cost me 1 million for 1.3 million rand. So what's going to happen from a recoupment perspective in my tax calc? We don't pay tax at the beginning of the year, we pay tax at the end of the year. So I'm going to put in a recoupment of 1 million rand into my tax calc itself. But I sold it for 1.3 million rand. So I've also got a capital gain. But with a capital gain, the capital gain is 300,000 rand. And it's not going to be fully taxable at the full amount. So I'm going to times that by 80%. And what's going to happen is the amount that's going to go into my tax calc is 300,000 times 80%, 240,000 rand itself. Okay. And I've plugged both of these into a tax calc. So when I sell it for 1.3 million, this is the amount of tax that I am physically going to have to pay on the transaction itself. Okay. And I'll get 1.3 million in time period 1. Okay. So I've plugged everything into a question. Okay. Because I'm doing a separate calculation for this, I don't need to put the minus 1.3 million into this calculation, because I'm going to compare. If I sell it, this is what it's worth. If I don't sell it, that 1.3 million notional cost is irrelevant, because I've taken it into account when I've done option 1. So that's what we need to do. Let's move on with the question, and let's go through fixed asset acquisition. Okay. So it says a factory would be set up in Johannesburg by renting a factory and purchasing a machine to make inverters. Second-hand machinery costing 1.38 million, including VAT, would be purchased on the first day of the tax year. That would be a cash flow. Okay. Just to remind you what's in the question, you would have read it before. What's going to happen? It says here, new machinery is written off at 40, 20, 20, 20. Second-hand machinery is written off 20% straight line without apportionment for tax purposes. In an exam, they normally won't give you that. You should know that. But I don't know whether you've done this in your tax before, so I'm just actually giving you the write-off policies themselves. So what's happening here? Second-hand machinery costing 1380. Remember, it's second-hand. Okay, so there's a cash flow there. Plus, there would be a tax effect for that as well, because we're going to have to write off that machinery as well. It says this machine has 2 financing options available. There they are. It says a new machine costing 200 x VAT would be purchased on the last day of the year. There's definitely a cash flow. There's definitely a tax effect. It's a new machine. And it says depreciation is calculated at 25% per annum. So what I'd like you to do now is I'd like you to try answer this part of the question by yourselves. Press pause now and then unpause when it's time to actually see whether you've done something right or wrong. I'm assuming that you've actually now done the calculation. Let's start going through it. It says second-hand machinery costing 1,380,000, including VAT, could be purchased on the first day of the tax year. You can get the VAT back. So it's 1,380,000 times 100 divided by 115. The VAT input can be claimed because it's a machine. It's a good used in your organization. You may claim the VAT in it. So how much did the machine cost ex VAT? You should have put in the cost of the machine as 1.2 million rand. Okay, so you need to do it ex VAT. So looking at our Excel spreadsheet, what would we do? This is not for option one. For option one, what did we do? We sold the research. Okay. For option two, we are going to say we purchased a machine. I've done it as not included in the tax calc because this amount that I'm putting into my calculation, this minus 1.2 million, is not going into my tax calc itself. I'm going to put other stuff into my tax calc. Okay, and I need to put it into the cash flow ex VAT. Okay, 1.2 million. There it is, the calculation that I did. Now, as part of the notes, I've actually got, again, a little bit of notes that deal with initial investments. So let's have a look at what these notes say. It says initial investment into a project should be shown at time 0 unless incremental investments are required in later years. So in this question, what happens? We've got 1.2 million and there's another machine up front. It says if there's a 1 million cost up front and boarding costs of 300,000 at the end of year 3, place 1 million into T0 and 300,000 into year 3. Okay. So inside this question, what happened? We had 1.2 million, 1.38 million including VAT. We put that in there. That's on the first day of the year. And then we've got a new machine costing 200,000 cash flow ex VAT. That happens on the last day of the first year. So let's go back here and let's go purchase a second-hand machine. And we also purchased a new machine. And what's going to happen with that? That one, sorry, the second-hand machine was in time period 0. Again, sorry, let me just put in the freezing of panes. Okay, so here it is. View, freeze panes. Freeze the panes so we can see everything there. Minus 1.2 million and purchased a new machine. How much did we buy it for? 200,000 ex VAT. We can claim the VAT on it. So the minus 200,000 will come into our tax calc over there. Okay. So that's what's there. Let's carry on reading through stuff. It says, knowledge of the tax write-off for buildings and machinery is assumed normally in an exam. New machine, 40-20-20, no apportionment. Second-hand machine, 20% straight line, no apportionment. Factory building is usually 5%. New and unused office buildings usually 5% as well. So it says, if a tax allowance can be claimed on this amount, remember to include this in the tax calculation. If T0 was a new machine, calculate the depreciation allowance as claimable and place these in a tax calc for 4 years and place the building in for 20 years. Okay, so I've got up here, I had 1 million cost up front, okay, for a machine and 300,000 cost later on. What are you going to do? You're going to put these into a calculation and write them off. So let's have a look at how it would impact upon this tax calc. So basically, I've got a second-hand machine in my tax calc. Second-hand machine. What's going to happen with the second-hand machine itself is I'm going to only claim a deduction at the end of year 1 on the machine. It is a second-hand machine, and I will be able to claim minus 1.2 million times by 0.2, because second-hand machines are written off at over 5 years. And what am I going to do? I'm going to put this all across. And that's V. And if I wanted to work out my tax value, just for now, I'm just going to go tax value. Okay, because I might sell it later on. It would be plus 1.2 million minus the sum of what? The sum of that, and that. So my tax value itself would be, at this point in time, did I do the calculation properly? Yeah, oh, sorry, it should be plus the sum of those because they're already a minus. I apologize. So it should be plus sum of those. So tax value would be 240,000 at the end of the period. Okay, the new machine, what happens? I buy it at the end of year 1. But even though I buy it at the end of year 1, because you don't apportion on machines, I get to claim plus 200, sorry, minus 200,000. What deduction do I get to claim? Times 0.4 in year 1. Plus 200,000. Sorry, minus 200,000 times 0.2 in year 2. And in year 3 and year 4. And guys, it's written off over 4 years. If you add all of that up, that actually all sums up to 200,000. So my tax value, it's fully written off at 0 for this machine. My tax value would be equal to 0 for the machine. Okay. And we should plug that in. Now, just to go back to the notes and just actually go through another principle as far as this is concerned. It says the way a project is financed is ignored when doing an NPV calc. If there's a machine costing 3 million, which is funded by a loan requiring 3 capital repayments of 1.2 million each, ignore the loan repayments and only put the investment amount of 3 million into year 0 into the calculation. Including finance charges would be double counting. The minus 3 million in times 0 hypothetically equals the 1.2 million paid in each of the 3 years. So as far as this question is concerned, when you did it, for those of you that then went and put either one of these 2 loans into the cash flow calc for the investment, that would be incorrect. This is what we call the financing decision, and it does not form part of an investment calculation. Okay, what we've got to put into an investment calculation is just the amount that the machine would cost, or the amount that the building would cost. You don't put in any financing into an investment decision. You haven't even decided whether you're going to invest yet. You should only deal with the financing side of things once you've decided to invest. Okay. The question carries on with depreciation calculated at 25% per annum. Okay. It says assume depreciation of 350 per year. What you need to understand with depreciation is not included in the tax calc. I'm going to put depreciation down. And depreciation is what we call a non-cash flow item. So what happens with a non-cash flow item, as far as depreciation is concerned, there's no effect on cash flow for depreciation. Okay? There's no cash effect itself. The cash effect is the tax deductions that we've already claimed. There's no normal effects for yourself. Now, once again, if you've made a mistake and your knowledge is bad on something and you made a mistake, create a stuff-up sheet and write down what you've made a mistake with. If you included the financing into a investment decision, on your stuff-up sheet, you should write down, do not include financing into a investment decision, explain what you did wrong, and when you're preparing for your year-end exam, always have a look at the stuff-up sheet to remind yourself not to make the same mistake that you made before. Just another thing, a lot of people say, why did I put depreciation into the actual calculation? Did you put depreciation into the calculation itself? Yes or no? Now, what I need you to understand is, to actually get a mark, you need to write something down. So if they told you what depreciation is, you should write it down with zeros next to it, because by putting zeros down, you're actually telling them not to put it into the calculation itself. If you don't write something down, you can't get a mark for it. And please just always be aware of that. Just carrying on going through the notes, just below the discussion of initial investment. Yeah, it says financing a project is considered separately in the financing decision as does not form part of the investment decision. If you have two options, either 1.2 million over 3 years or 800K over 5 years, this would be a finance decision and not an investment decision. First, you need to decide whether you will undertake the investment. Once the answer to this is yes, then you do the financing decision. At this stage, 3 payments of 1.2 million each could be compared to 5 payments of 800 each, not as part of the investment decision, but part of the financing decision itself. We just put the cost of the asset in. We ignore all financing itself. Carrying on with the question. Let's see. Next thing says working capital. I'd like you to attempt doing working capital properly by yourselves, and then push pause here. Once you finish doing working capital by yourselves, come back and watch the video. I'm assuming that you've done working capital by yourself. It says working capital is required for the factory. This is to be financed by spending 200,000 in new purchases and taking existing costs that cost 30,000 that has a resale value of 50,000. It is estimated that the cost of working capital will increase at 5% per annum. So before I do the answer to the solution, what I want to do is I just want to go through the actual notes themselves. Okay, so inside the actual notes, number 4 says, only use relevant costs. So let's just go through. It says, if you have raw materials that cost 100, but would cost 150 to replace, use the 150 in your cash flow calculation. So inside this question, look what happens with working capital. Okay, it says, I'm going to take working capital from what I've got at the moment. It says I'm going to take existing stock that costs 30 but has a resale value of 50. So what am I going to do inside my calculation itself? I'm going to take working capital, and working capital is not part of your tax calc. Working capital is not included in the tax calc. And this is the great thing about using a spreadsheet in the exam. You can just insert some extra columns and you can put it in. So working capital, stock, it cost 30, but it's worth 50 now. So what's the relevant cost to put in? Minus 50,000 Rand. That is how much I'm going to have to put in for working capital for stock. Carrying on as far in this question itself, it says we also need to finance it with 200,000 in new purchases itself. So how much would I put in for working capital in total for the new purchases? 200,000 Rand. As part of my Excel spreadsheet, I'm just going to change this to minus 250,000 Rand. And that would be in time period 0. That would go into time period 0. Okay, let's carry on. It says it's estimated the cost of working capital will increase at 5%. So what I need you guys to do is I need you guys to carry on reading through the next set of considerations. Guys, it says here, working capital. It says working capital investment is not tax deductible. It is shown as an outflow in the year it's expended. So what have we done? Minus 250,000. It says working capital should flow back into an enterprise at the end of the life of a project. Consider you open a chicken licking franchise and you buy chickens as working capital. At the end of the life of the project, you stop buying chickens and run your chicken stock down to 0. So do you understand? The working capital comes back to you. Okay. It says if the working capital quantity does not change but gets more expensive due to inflation, only the increased amount that working capital costs will be reflected in the cash flow. And that's what we've got in this question. What does it say? It says that working capital is going to get more expensive by 5% each and every single year. in this question. So we need to take that into account. So remember, we've got to get the working capital back at the end. But because with inflation, working capital is getting bigger each year, what do we need to do? We need to put the increased amount it's going to cost us to buy more chickens for that chicken licken. Because yes, it would cost 250,000 rand to buy chickens now, but at the end of the year, it would cost 250,000 times 1.05. Look, add an extra 5% onto the cost of chickens. So let's add this 5% per annum on within our Excel spreadsheet. So how much working stock will there be at the end of the year? It's going to have increased by 5% at the end of the year. So how much would I have paid during the year? I would have paid that amount times by 0.05. So another 12,500 rand. At the end of time period 2, I would pay, and watch what I'm doing. I'm going equal sum, the sum of these two numbers. Okay, and I'm going to times that by 0.05 because it would be both of those numbers. For this one, I'm going to go equal sum. These three numbers, that's what it cost last year. How much extra would I have paid this year? Times by 0.05. I would put the 13,781.3 in there. And in this year, I would say equal sum. All of these times by 0.05. So each put times 0.05. Sorry, so let me just fix up the thing. 0.05. Why is it not working? Let me just type it again. Equal sum. All of these blocks times by 0.05. There we go. Minus 14,470.3. Now, normally in an exam, you're not required to get that, so I would just change this to minus 14,470. And I would change this one to minus 13,781. There we go. So there's your working capital stock. And what's going to happen? I get working capital back at the end. Because this is how much chickens I've got on hand, the sum of all of those items. So how much am I going to get back? I'm going to equal minus the sum because all of those are negative numbers. And I just add up these 5 numbers together. And I'm going to get back 303,876 Rand at the end of that period. That is how much I'm going to get back. Okay. So that's just for you guys to bear in mind. Okay. So next thing. Let's carry on. That's working capital done. Next thing. Sales and operating costs. What I'd like you to do is I'd like you to read through this and try to do this as part of your calculations. And I will go through this with you once you finish doing it by yourselves. See whether you can actually do this properly and see what you make a mistake on. Please press pause now, do it, and then unpause this video to carry on. Okay. I'm assuming you've now done everything. Okay. What I'd like to do before we go through this section is I'd like to go through the supplementary notes, just like I've done with everything else. Okay. So it says, number 1, know the difference between markups on cost and on sales. It says so if there's a markup of 50% on cost and sales are 100,000, if it's a markup of 50% on cost, you need to sit there and say, listen, cost is 100. The markup on cost is 50. So sales would equal 150. So that's what this one is. Okay. So if sales are 100,000, how do you work out stuff? If sales are 100,000, you go 100,000. And to work out my profit, I would say times by 50 divided by 150. And that will give you 33,333, which is the answer that you have over there. If there's a markup of 50% on sales, what you then need to do is make sales equal to 100. There's a markup of 50% on sales, so the GP would be 50, which would mean that the cost is 50. So if that is 100,000 Rand there, let's just take it up. It would be 100,000 Rand. And how much would your profit would be? 50 gross profit divided by 100 for sales. And that would be 50,000 Rand. So there's 50. So see whether they give you markups on cost or markup on sales, and make sure that you do your calculations properly with it. Let's carry on. Next thing. It says different cash flows may have different inflation rates as time progresses. Always use nominal, not real cash flows. So let me just explain something. Okay, when you buy a machine, the machine costs R1 million in time period 0. Your depreciation is going to be 40, 20, 20, 20. Okay, or 20% straight line. Your tax never ever changes. So you've got to put tax in at historical numbers. Okay. However, your sales and your expenses may be inflation adjusted. Now, tax is not inflation adjusted, whereas your income and your expenses are inflation adjusted. So you can't use real cash flows. You can't sit and say this is a real tax cash flow and this is a real sales cash flow. Okay. First of all, sales may have a different inflation rate to your expenses. Your salaries might be 14%, your sales might be 7%, and your rent might be 8%. You can't use real rates. You have to use nominal rates in a question. So it says here, always use nominal, not real cash flows. It says sales may have an inflation rate of 7%, salaries at an inflation rate of 10. This is relevant in SA where salary inflation has outstripped inflation. You've got different inflation rates. You've got to put the actual numbers in. It says, read each question carefully and adjust the cash flow accordingly. Okay. So we need to take that into account when we did this. It says here, if probabilities are given, calculate the amount of the cash flow using probabilities. If there's a 20% chance of sales of 100, so 20% times 100 gives me 20. And it says 30% chance of sales of 120. I've got 30% times by 120. If you do that, you end up with 36. And it says, and a 50% chance of 150, 50% times by 150, that would give me 75. What you'll do is you'll add all of that up. So 75, 95, 131. That's the number that you would put into your cash flow. Okay. So you put in the probable cash flow into your cash flow. There's a thing called sensitivity analysis, which we might do a little bit later. And we can actually assess the sensitivity of this to our cash flow itself. Okay. Next one. If foreign exchange amounts are given, the following should be considered. If the payments at the beginning of the year, use the rate ruling at the beginning of the year. If payments is at the end of the year, use the rate ruling at the end of the year. If payments are made throughout the year, use the average rate for the year. So we're now ready to progress to do this question. Okay, so let's see, just mark yourself and see what you did wrong. Often you don't practice this. You don't realize that you don't read properly or know how to do something properly. So mark yourself now and see whether you understood all of these basics. If there's a problem, please put it onto that stuff up sheet. It says sales will be 2.2 million per store in year 1, and we'll have a gross profit of 60% on cost. So what are we going to do? We're going to say, listen, cost is 100. GP will be 60% on cost, which gives you 160. Okay. It says gross profit will grow by 8% for 2 years and reduce by 15% per annum thereafter. So there's your impact, your inflation impact. So it's per store, so remember that there's 3 stores. So what are we going to do in our calculation? It's part of our sales. We're going to include this in a tax calc. Sales. Okay. Well, actually, we're going to do gross profit. So what's going to happen here? We're going to sit there and say, listen, it's plus 2.2, sorry, not in time period 0. Time period 1, plus 2.2 million per store. So there are 3 stores times 3. Times by How much is my profit? My profit is 60 Rand out of every 160 Rand. Okay, and that is going to be how much gross profit I'm going to make from this calculation itself. Okay, it's probably better that you actually write out the calculation over here. So 2.2 million times 3 times by 60 divided by 160. Okay, just in case they need to carry errors through. Now, as far as this question's concerned, there's where we got gross profit was 60 over 160. Okay, now, as far as the rest of it is concerned, the question says we're going to grow by 15%, 8% for 2 years, and then 15% down thereafter. So what are we going to do? We are going to say year 2, and what's in year 2? Essentially, it's going to be 2,475 times by 1.08. Okay, that's if you want them to mark your errors. So it would be plus 2,475 times by 1.08 because it's growing. Year 3, 2.673 times by 1.08 because it's going to grow by that for 2 years. So what are we going to do? I'm going to say plus that number there times by 1.08, 2886, 840. And then year 4, it said that it's going to reduce by 15% in the year. So that is 2886, 840, and if it's going to reduce, it's times by 0.85. Okay, so plus that number times by 0.85. There we go. And there we have our cash flows for our sales. Okay, let's carry on. It says salaries are expected to be 900,000 for year 1, increasing at 10% per annum for 2 years before stabilizing. Okay, so now I've got to do salaries. Salaries, year 1, minus 900,000 Rand. Remember, it's an expense, it's got to be a minus. Year 2, it says, and the question is going to increase by 10% for 2 years. So what's going to happen with this? Plus that times by 1.1. And plus that times by 1.1. There we go. There's our sales, salaries, it's increasing. And then it says it's expected to stabilize. So plus that number, I'm going to put that in as your stabilization number for the calculation. So there's the number that you actually have through for it. Okay. Carrying on. It says there's a 40% chance operating costs for the whole company, including depreciation, will be 1.85 million per annum, and a 60% chance it will be 2.1 million itself. So we're going to have to do some sort of working now. So let's go in and let's actually try to do a working. So 60% chance it'll be 1.85 million. Okay. Sorry, the question that I had up was the wrong version. So this is the one that you've done. There's a 40% chance that operating costs for the whole company, including depreciation, will be 850 per annum, and a 60% chance they'll be 1.1 million Rand per annum. So as part of your calculation, this should form part of your solution. What you should do is you should say, listen, it's a 40% chance of getting 850, and it's a 60% chance of getting 1.1 million. So if you had to do a number crunch on that, you would basically do, you'd say it's 0.4 times by 850. And how much would that equal to? That would equal to 340,000 Rand. Okay, 0.6, clear it, 0.6 times by 1.1 million, 1100. that would give you 660k. And if you had to add all of that stuff together, 660 plus 340, that would come out at 1 million itself. So you'd have to have 1 million in your calculations. So it's a 1 million operating expense, but remember it includes depreciation. And later on in the question, what happened with this? It says that, assume that depreciation is 350 a year. So what are we going to put into our Excel spreadsheet? We are going to say our operating expenses, excluding depreciation. That's what's going to be a cash flow, and that's going to be minus 650,000 rand. 1 million, take off the 350 for depreciation, and you're going to put it in. And they didn't mention inflation with this item, so what do we need to do? We just going to put the 650 all the way through. They did not mention inflation, so we leave it as 650,000 rand, which is possible. You could enter into a rental contract where there's no escalation. There's all sorts of things that might happen with that. So let's move on. Okay. The next thing that happens, it says marketing costs will be 200,000 and will reduce by 20% per annum based on initial marketing costs. So 20% down on initial marketing cost. So what's going to happen as part of the solution, as part of the Excel spreadsheet, you're going to have a marketing cost. And how much is the marketing cost? Minus 200,000 Rand for year one. Okay. And it's going to reduce by 20% on that each year, because it says it's based on the initial marketing cost. So 20% of 200,000 is now 160, and it's based on initial marketing cost. So each year it will go down by a fixed amount. Again, you need to read the question properly and see what you're doing there. Carrying on. It says certain function will be outsourced to an Indian call center for the first year. $1,000 a month will be paid for the service. Based on sales, a bonus of $3,000 will be paid at the end of year one. The company believes there's a 100% chance that this will be paid. If it said 90%, you'd go 3,000 times 90% times by an amount. Now the question is, this 1,000 Rand a month, that's 12,000 for the year. If it's incurred monthly, what rate do we need to use? The best rate would be the average rate for the year, so times 15.5. This 3,000 is incurred at the end of the year, so what's the best rate for it? The rate at the end of the year, so that would be 3,000 times 17. So looking at our solution, what are we going to do? We're going to say monthly outsource cost. Always better to show them what you're doing so they can carry an error through, times 12 times by 15.5. Okay, using the average rate for the year, that would be in time period 1, so it would be minus 12,000 times by 15.5, and that would be minus 186,000 Rand. Need to add on a couple more lines because I've run out of space here. Okay, and okay, year-end outsource, that's going to be 3,000 times by 17 minus 3,000 times by 17 is going to give you minus 51,000, and you're going to have to put that into the actual calculation itself. Let's carry on the question. Going back. It says the inverters will be sold for 4 years before new technology would render them obsolete. The machines will be sold for 400,000 excluding VAT at the end of year 4. So what I'd like you to do is, I'd like you to do this as part of your tax calculation. Please press pause now, and then we'll go through how to do this in a solution. I'm going to assume that you've actually done this now. So before we do it again, just let's go down and see the considerations that we've got. It says, when assets are sold, the tax calcs on disposal should be included in a tax calc. The actual amount that the asset is sold for should be a cash flow. So how much did we sell it for in this question? We sold this for 400,000 Rand. So this 400,000 Rand, I've got to go put it into the question itself. So let's go into the Excel spreadsheet. It's not going to go directly into the tax calculation. So I'm going to sit there and say, sale of machinery. And how much am I going to sell it for? 400,000 Rand at the end of year 3. So, year 4, sorry. So 400,000 is what it would be sold for at the end of year 4. Carrying on, let's go back. It says consider recoupment, capital gains, scrapping allowances, and capital losses. Capital gains have inclusion rates and are not taxed at the same rate. So for a company like this, it would be times by 80%. I've got you to remember, scrapping allowances are not granted on buildings, intangibles, and assets with a life of more than 10 years. You need to just remember, when you're actually doing NPV calcs, you can't claim scrapping allowances on buildings or intangible assets, or if an asset is written off over more than 10 years. Scrapping allowances cannot be claimed on intercompany transactions. And then capital losses may only be used if they're capital gains to set them off against. You can't claim a deduction for it. It only works if there's a capital gain. And capital losses are ring-fenced in certain intercompany transactions. Now, this is all going to be covered in the tax syllabus, but I've just put it into the management accounting notes just in case you actually get something inside a management accounting question. Okay, so that's there. So let's just go through and let's actually do the recoupments or the capital gains. So let's have a look inside this question. Let's get the information. What happened? It was sold for 400,000 Rand excluding VAT. That's great. So going into the Excel spreadsheet, when we did the tax calc, what happened? We did do the tax values. The tax value is 240 plus 0, which is 240. That is below cost, so there's not going to be a capital gain. And how much is the recoupment going to be? The recoupment is going to be 400,000 Rand, is what it got sold for, minus 240,000 Rand, which is the tax value itself. And what are we going to do in year 4? There's going to be a recoupment of 160,000 Rand that we are going to take into account as part of this question itself. There's no capital gains. We did not sell it for above cost. Okay. Moving on with the question, it says WACC. The company has a weighted average cost of capital of 10%. This project is riskier than what the company traditionally does, and a risk premium of 2% is considered appropriate. So this would be 10% plus 2%, and we would have an appropriate discount rate of 12% for this question itself. So what I'd like you to do now is I'd like you to add up everything that you've got, and I'd like to see whether you can do an NPV calculation and do an IRR calculation. But before we do that, okay, we're going to have to do the tax calc itself. So I want to just discuss the tax calc. So let's just go here. It says the following should be considered for taxation. Taxation is a cash flow and should be calculated separately. Often cash paid does not equal a tax deduction. An example of this would be a fixed asset purchase where wear and tear is calculated over the entire life of the asset for tax purposes. If tax paid is paid, place it into a cash flow calculation in the year it is paid. If there's a loss, carry forward to next year, because SARS don't give you a refund if you make a loss. And just in general, assessed losses within a company should not be taken into account when calculating a cash flow, as the project should stand by itself. But I'm going to discuss this in a lot of detail later. This is in my more complex considerations. I have a separate chapter on complex considerations, and I'll show you examples of this. So, and then just again, it says WACC should be used in a net present value calculation. Okay? It says this assumes that the risk of the project is the same as the risk of the enterprise. Where this is not true, WACC should be modified. If WACC is 14 and there's a 6% risk premium attached to the project, use 20% as a discount rate. Okay, so let me just explain what I've done now. So remember, I've been separating things out. So all of the stuff that's included in the tax calculation, this gross profit, all of this across here, all of the stuff that's been included in the tax profits, you can just copy it. What you can then do is you can go and put it down at the bottom here into the tax calc and just paste it across once you're finished. So if you separate the two things out, you don't need to go through and do things in two places at the same time. You can just copy it at the end. Alternatively, if you don't want to actually do that, you can just go and copy the lines and then paste them into the tax calculation separately. Now this is where the whole benefit of using a spreadsheet comes into play. So what we can do now is I can highlight this line if I want to. Okay, so or I can put a little square around it. There, thick border. I can now add up all of the columns. I can go equal sum and add up everything all the way up to the top. As you can see, I can then copy that formula across and get calculations. And then my tax is going to be at 28%. And what can I do? I can say plus 0.28 times by that number equals, and I can copy all of this across here, and my tax calcs are done nice and quickly. And then what can I do? These are my tax cash flows. So what I can go and actually do inside my question is I can say, listen, I've got a tax cash flow. How much is the tax cash flow? It's minus this number at the bottom. Enter. And I can just copy this across and put my tax cash flows into a question. No problem whatsoever. And I can plug all of that stuff in. Okay. I see that there's some lines here, so I'm going to just delete out those lines. Okay. And now what I can do is I can quite simply put a line through. I can go equal sum. And I can add up all of the cash flows that I've got for the whole question. And I can save an absolute fortune of time by doing something along these lines. It is much, much quicker to actually do something like this. Now, as you're doing the question, what you need to do is you need to actually tell them what you're going to do as part of the calc. So that's cash flow time period 0. I'm just going to pull this across. Those are all up to cash flow time period 1, 2, 3, and 4. I'm going to say, what is my discount rate? My discount rate is equal to 10% plus 2% risk premium, which is equal to 12%. Okay. And I'm now going to calculate my Npv, and I'm also going to calculate my IRR, because that's what the question asked me to do. Asked me to do both of those. Okay, Npv and IRR. So how are we going to do this? I'm going to pull out my financial calculator again, and we're going to do this as part of the financial calculator. So let's start. Clear your calculator. You're going to say, listen, 1,450,000 minus is going to be my first cash flow 0. 228,640 is going to be my second cash flow. Sorry, I made a mistake, but that's 640. I'm just going to start it again. Apologies. So 1,450,000 minus first cash flow 228,460 is your cash flow 1. 693,835 is your next cash flow. Sorry, the next cash flow 2. 804,664. It's going to be my next cash flow 3. And then 1180 072, 1180072. That's going to be my fourth cash flow. My discount rate is 12%, so that is my I, and I'm going to go second function, NPV. And how much do I end up with? 629,804. 629,804. How much is my IRR? I'm going to go second function, IRR. And I'm going to end up with 27.2%. Okay. I also need to do option 1 now. What's going to happen with option 1? I've got sale of market research 1.3 million. Delete that. I've got a tax calc here. Let's just fill in the tax calc itself. So what's my taxable income? My taxable income is plus that, plus that. That's going to be 1.24 million. And how much tax am I going to pay? My tax that I'm going to pay is plus that amount times by 0.28. And that's going to give you 347,200. So what am I going to have to do? I'm going to have to go put that tax into the tax calculation. So tax payable is going to be minus this amount. Now I'm going to have to add up all of my cash flows. So this is going to be equal the sum of all of this. Let me copy that across down to there. And what's going to end up happening? That's going to be cash flow 0. And this one's going to be cash flow 1. And if I'm going to calculate my NPV and my IRR, once again, I've got to pull out my financial calculator. I'm going to have to say, listen, what's going to end up happening with this one? 1.3 million positive cash flow is going to be for period 0. 347,200 minus is going to be for cash flow period 1. Okay, 12 is my discount rate. And second function, NPV. That's going to give me an NPV of 990,000 rand, as can be seen. And how much is my IRR? Second function, IRR. It's going to give me an IRR of 73.29%. So which one am I going to choose to do in this question? Which one am I going to choose to do? This one has got NPV of 990. This one has got an NPV of 629,804. So what's going to end up happening? I'm going to choose to sell this investment. I would not do the research by myself. It is better for me just to take the 1.3 million rand cash now, pay the tax on it. I'll make more money in the long term with it.